In this video, we're going to talk about saving, investment, and the financial system. So let's think about what you would need to do if you wanted to start a business. So for most people who are going to start a business that's going to require equipment and maybe a building and things like that, most people don't have those financial resources just sitting in their bank account. Typically what has to happen is that you need to go to a bank and borrow some money to buy the equipment and maybe to have a building built and the things that you need to do to start the business. So let's think about that process, the process of borrowing somebody else's purchasing power. And we're going to think about it within the context of the financial system. We'll talk about the U.S. financial system, but the financial system of any economy is going to be very similar to this. So the definition that we're going to use for the financial system, that's the term that we're going to use for the institutions that coordinate one person's saving with another person's borrowing. So if you want to borrow money, you need to find somebody that has some money right now that they don't want to use. And if somebody who has money right now that they don't want to use, those people are saving. So borrowers and savers, the savers are the source of the money that you want to borrow. And of course, the people who want to borrow it need to find those savers. So it's the financial institutions or the financial system that kind of bring the savers and borrowers together. That's what we're going to be thinking about. So let's think about some financial institutions. And the first thing that we're going to think about are what we call financial markets. Financial markets. So these are institutions through which a person who wants to save can directly interact with a person who wants to borrow. They directly interact, the saver and the borrower. The first type of financial market that we're going to think about is the bond market. So let's talk about what a bond is for just a little bit. So a bond essentially is a certificate of indebtedness. That's all a bond is. It's nothing more than an IOU. Okay? So it typically would take the form of maybe some type of certificate, the bond certificate, and on that certificate, the obligations of the borrower would be specified. Okay? So the seller of the bond is the borrower. The buyer of the bond is the lender. Okay? So let's think about the things that are specified on the bond. So of course there's going to be a maturity date. This is a loan, and so the date at which the loan will be repaid needs to be specified, and we call that the maturity date. There's going to be a rate of interest. That rate of interest is the amount of money that the borrower is going to pay to the lender. And there are millions of different types of bonds out there. There are bonds that are sold by corporations. There are bonds that are sold by federal and state and local governments. Let's think about some characteristics of different types of bonds, because a city bond, a municipal bond, is not going to be the same as a federal bond. So if we think about some characteristics, let's talk first about the term. Term has to do with the maturity date, but the term is going to be the length of the loan. It's the length of the time until the bond is going to mature. So there can be some bonds that have very short terms and some bonds that have very long terms. So a short term might be a few months. A long-term bond might be 30 years. And if we think about the interest rate that's going to be paid by that bond, if we hold everything else constant and we just think about the effect that the term has on the interest rate, what you start to realize real quickly is that the longer the term on a bond, all other things equal, the higher the interest rate. Because essentially what's happening here is that the borrower is asking to borrow somebody's money for a long stretch of time. A lot of things can happen over a long stretch of time. So to get people to lend money for that amount of time, you have to offer to pay a higher interest rate. And that really boils down to the basic fact that, that longer-term bonds have more risk associated with them. Another characteristic of a bond would be the credit risk. So if we think about what that is, credit risk is the probability that the borrower will fail to repay part or all of the amount of money that they borrowed. So the amount that's borrowed we call the principal. And if the borrower fails to repay part or all of the principal, we say that they have defaulted. And if you think about different types of bonds are going to have different amount of credit risks. So a bond that is sold by the federal government is going to have a much lower credit risk than a bond that's sold by a corporation. Because of that, a federal bond typically offers a lower interest rate than, say, a corporate bond. And what's happening there is that the riskier the bond, the higher, all other things equal, the higher the rate of return. We tend to have a term that we use for higher risk bonds. We call them junk bonds. And that phrase, junk bonds, simply refers to the fact that they have higher risk than other types of bonds. And then the last characteristic of a bond would be kind of the tax treatment. So the federal government is going to treat any income that you earn from a bond, any interest income that you earn, the government's going to treat that as taxable income. One exception to that would be a municipal bond. Municipal bonds are typically going to be tax-free. That gives those municipal bonds a little bit of a kind of a advantage over other types of bonds. And because of that, the municipal bonds, all other things equal, have a little bit lower interest rate because they have this favorable tax treatment. So that's going to be the first type of financial market. Let's think about now, instead of the bond market, let's think about the stock market. And keep in mind that with a financial market, the borrower and the saver are going to be interacting directly with each other. So if we're thinking about the stock market is going to be another way for an institution to raise funds. And a stock represents ownership. So a share of stock represents ownership in the corporation. Represents ownership. It represents a claim to the profits of the business. Now, how much ownership a particular share of stock represents depends on how many shares of stock there are. So if the corporation has sold 1 million shares of the stock and you own 1 share, then you own 1/1,000,000th of the firm. Clearly, the more shares you own, the more ownership claim that you have. If we're thinking about selling stocks versus selling bonds, both of them can be used to raise money, to raise funds, but we call the sale of stock equity finance because what's being sold is ownership. This is equity finance. The sale of bonds we would call debt finance. You're borrowing money. Two fundamentally different ways of raising funds. So if you own a share of stock, you are a part owner of the business. If you own a bond, you are a creditor of the business. And that distinction is important because if the business were to go under, if they were to declare bankruptcy, the creditors are treated differently from the owners. You have no claim to any of the liquidated assets of the business if you're an owner. But if you're a creditor, then the court system would recognize your claim to some of the assets depending upon how much money the business owed to you as a creditor. You would at least have some claim. Okay, that doesn't mean that you're going to get anything, but you do have a legitimate legal claim. Going back to the stock market, there are shares of stock are bought and sold on stock markets. So we could think about the New York Stock Exchange. We could think about the National Association of Securities Dealers Automated Quotations, NASDAQ. It's not important that you remember what that stands for, but it's just another example of a stock exchange. There are stock exchanges all around the world. Let's think for a second about how the price of a share of stock is determined. So every different type of stock is different. So Walmart shares of stock are going to be different from Apple shares of stock. But if we think about shares of stock for a particular business, let's think about Walmart. A share of Walmart stock is like every other share of Walmart stock. It simply represents a claim to the profits of the business. If we're interested in understanding what determines the price of a stock, it actually, at least conceptually, is very straightforward. It just boils down to demand and supply for those stocks. So if we were to think about what determines the price of a stock, then let's look at the number of stocks that are out there, and let's look at the price up here. This is going to be just a demand-supply model. The nice thing about the supply is we know the number of stocks that are out there, and it's not dependent upon the price. The supply curve in this case is vertical. And if we look at what the demand curve looks like, it's going to be downward sloping, and of course the intersection there is going to determine the price. Now the supply doesn't change very often. Okay, so for all practical purposes, we can treat that as if it's just going to sit there. So if you want to know what causes the price of a share of stock to move, and they move constantly, you can look at the stock ticker and see that they move all the time as long as the stock exchange is open. What's going to be happening there is that it's going to be driven by changes in this demand curve. So understanding what causes the price to change boils down to what causes the demand curve to shift. And one of the most important determinants of demand when we're talking about share of stock is not so much income or the prices of related goods or tastes and preferences. It's typically going to boil down to expectations of the buyers. Expectations about future profitability of that business. And so if people expect that business to be profitable in the future, then their expectations are going to drive maybe an increase in demand, and that's going to drive that price up. And these expectations can be influenced minute by minute by a variety of different things. The profitability of a corporation, of course, is determined by what it does, new products that it offers, legal changes that might affect it. It's going to be determined by what other businesses that are competing with this business do. It's going to be determined by the overall profitability of, or how well the economy is running right now, and how well people think the economy is going to be running in the future. Understanding how to predict this, good luck with that. You would need to know how to predict what people's expectations are going to be in the future. So I as an economist would simply say, hey, I'm not sure I know exactly how to predict expectations. And here's the thing, you would need to know how to predict them before anybody else predicted them in order to take advantage of this future price increase. Once you see that something's happened and everybody else sees that something's happened, the demand curve is going to shift and that price is going to change and you've missed out. So I'm just going to leave it at that and say that it's challenging. I'm not going to say you can't do it. Let's just move on. Let's talk now. We just talked about financial markets. Let's talk about financial intermediaries. Financial intermediaries. So here's what's happening with these. This is going to be a situation where there's some institution in between the borrower and the lender. There's going to be an intermediary, a middle institution. Okay, so an obvious example of a financial intermediary would be a bank. So what a bank does is a bank takes in deposits and makes those deposits available to the people who have made the deposits in the form of a checking account, a savings account, something that you could use, maybe your debit card, to access the money. And then what the bank does is they turn around and they lend that money to other people. So a bank takes in deposits and they make loans. And of course, they make the loans at a higher interest rate than what they pay on their deposits. That's how they make money. Banks also play another role, and that is that they create a financial asset in the form of what we call demand deposits, checking account. So demand deposit or a checkable deposit. That simply means that the bank will hold on to your purchasing power for you and allow you to use either a written check, which most people don't use these days, or it'll allow you to use maybe a debit card to access the funds that are in there. So that debit card is another asset that you can use to buy goods and services. So the bank creates this financial asset that we can use. We can talk about other financial intermediaries. There are mutual funds. A mutual fund essentially is an institution that takes in deposits and then it uses those deposits to buy a portfolio of maybe stocks and bonds, other financial assets, and then some mutual funds might allow you to use something similar to a debit card to access the funds in there. But essentially they're bringing the borrowers and the savers together in a way very similar to what a bank does. There are other types of financial intermediaries that we could think about, other types of institutions like credit unions. We could think about, say, pension funds. There are a variety of them. But the idea with all of these financial intermediaries is that there's some institution in the middle that's bringing together the borrower and the saver. Let's talk about the national income accounts. We've discussed that before, but let's think about what brings together saving and investment. If you think back to the national income identity, you've seen it before. It's Y equals C plus I plus G plus net exports. So total GDP is made up of consumption and investment and government spending or government purchases, and then net exports, exports minus imports. So this is an identity. This is true by definition. It means that any dollar that's in GDP is going to be a dollar that's in one of these categories. What we want to do in this chapter is we're going to make things a little bit easier on ourselves, and so we're going to think about a closed economy. We're going to take that out of the picture, just make that zero. So we're going to think about an economy that neither imports nor exports. So our national income identity is going to be Y equals C plus I plus G. What I want to do is I want to move some of these things over to the left side. I'm going to leave investment over there on the right side, and I'm going to say that Y minus C minus G is equal to I. All I've done is rearrange that. If you think about what's going on here on this side, we've got income minus consumption minus government spending. That's just going to be the total amount of income that remains after we pay for consumption and government spending. We call that national saving. So when we rearrange it this way, we call this side national saving. We denote it as S. And what this tells us is that the amount of dollars that fall into this category of investment is going to be equal to national saving. We can just write it, saving equals investment. Now let's play around with this a little bit more. Let's let T denote taxes. This is the amount that the government's going to collect in taxes. And we're going to think about that as tax collections minus the amount that they pay back to people in the form of transfer payments. A transfer payment is simply where they're transferring income from one person to another. So let's start with this. National saving, S, is equal to income minus consumption minus government spending. This is for an economy as a whole. We're talking, this is the economy right here. National income, okay? Not an individual person. I'm going to add a t, I'm going to subtract a t, I'm going to do some algebra on this that's going to make it look different, but it's not really going to change anything. I can kind of group some things. I can say y minus t minus c. I'm going to put that in one set of parentheses. And then I'm going to add t minus g over here. So if you look closely at what's going on here, all I've done is I've subtracted t and I've added t. These two t's cancel out. I haven't really changed anything. But this grouping allows us to kind of examine the components of national saving. We've got a name for this term right here. We call this private saving. Private saving. And this one we call public saving. So if you look at this one, this is income minus taxes minus consumption. If you were to think about just what happens for you as a private individual, if we looked at your income and we subtracted off what you have to pay to the government in taxes, and then we also subtracted off what you consume. So the money you spend on pizzas and tuition to going to college and tennis shoes and all of that stuff, we subtract all of that off. What's left over would be however much you're saving. This term right here is tax collections by the government. This taxes would be the government's income, minus what the government spends. That's public saving, okay? Government saving. So if we think about this term a little bit more closely, if T is greater than G, then we describe that as a budget surplus. If the government income is bigger than what they spend, then this is a budget surplus. Budget surplus. I started to just write surplus there, but I don't want you to be confused by a demand-supply picture where quantity supplied is greater than quantity demanded. This is a budget surplus. If T is less than G, if government spending is bigger than what the government brings in terms of taxes, we call that a budget deficit. So, we'll talk later about this. We'll think about what a government budget surplus and a budget deficit, what impact that's going to have in terms of saving and investment and all of that stuff. But for now, this gives you an idea using the national income identity of this basic conclusion that we get that saving equals investment. That's important. Now remember how we're using the term investment here. Investment refers to businesses buying equipment and buildings. Okay, this is not purchase of stocks and bonds. If you're purchasing a stock or a bond, what you're doing is you're saving some of your purchasing power for the future. Okay, so we need to know what is it that for an economy makes this true. For an individual person or an individual business, saving and investment don't have to be equal. But if we're talking about the economy as a whole, they're going to be equal. And our question at this point is what brings them together? And if I were to ask a face-to-face class, what do you think it is that brings saving and investment into equality with each other? Most of the time, at least this point in the class, most people wouldn't have any idea, but what it boils down to is going to be supply and demand. Turns out that a lot of times in an economics class, if a professor asks you, what causes this to happen? If you answer supply and demand, a lot of times you're going to be right. That's a pretty safe answer. So let's take a look at how supply and demand for loanable funds brings the number of dollars saved in an economy into equality with the number of dollars that are invested in an economy. So I need to clear this off and then we'll take a look at that. Let's develop a very simple market for loanable funds model where we start with just one. Let's assume that there's only one financial asset out there. That means there's only going to be one interest rate. We know that out there in any economy there are going to be lots and lots of different financial instruments, different interest rates, but we want to start nice and simple. So let's start, this is going to be the demand and supply of a loanable fund. Let's say demand and supply of loanable funds. You'll hear me refer to this model quite a bit, actually. Several times during the rest of the semester, we'll kind of come back to this and remind ourselves of some things that we learn with this. So the demand and supply of loanable funds. Let's think first about the supply of loanable funds. So let's start with the supply. The supply of loanable funds comes from the people who are saving some of their purchasing power for the future. So they maybe have more income than they need to spend right now, and so they save it by buying a stock or a bond or putting it into a checking account or a savings account. So saving is the source of loanable funds. I'm going to say saving, it's savers. Those are the people represented by the supply of loanable funds. The demand for loanable funds, this comes from households and firms that want to borrow money to make investments. Okay, so these are going to be, say, firms buying equipment. It could be firms buying buildings, structures. Could be households taking out mortgages. We would call that residential investment, taking out a mortgage. A mortgage is simply a loan for a house. Let's say mortgages. So the demand for loanable funds, people who want to borrow money to engage in investment. The supply of loanable funds is representing people who are saving some of their purchasing power for the future. And if we think about the interest rate is simply a price. The interest rate is the price of the loan. Okay? It represents the amount that borrowers have to pay to borrow somebody else's money. It represents the reward that you get for lending your money out. Okay? So the interest rate is nothing more than a price. Price of the loan. So if we think about how the demand curve and how the supply curve look, it's going to be very intuitive. Let's start by thinking about the demand curve. Let's put a little demand curve right here. Let's put up here the price, which is the interest rate. I'll just call it R. And then we'll put down here the quantity of loanable funds. So we've got price and quantity just like we've always had. If you think about the demand for loanable funds, the higher the price of the loan, all other things equal, the smaller the number of dollars that people want to borrow. And the lower the price of the loan, the higher, all other things equal, the higher the quantity of dollars that people want to borrow. So the demand curve for loanable funds looks like we would expect a demand curve to look. If we think about the supply of loanable funds, here's the interest rate. Now if we think about taking the point of view of the savers, the interest rate is going to be the reward to lending out money. And if the reward is low, all other things equal, people are going to want to lend out or save less. The reward to saving is smaller, you want to save less. As the reward goes up, all other things equal, people would want to save more dollars. So the supply of loanable funds also looks exactly like we would expect the supply curve to look. Now the interesting thing about this picture is it's just a demand-supply picture here, this is a supply picture, demand picture, we've got price up here. This quantity is not the quantity of some good like the number of pizzas. This is a number of dollars. Okay, this is the quantity of dollars lent or saved, the quantity of dollars borrowed. Okay. I know myself well enough to know that when I work through this model, a lot of times I will call this the saving curve. I will accidentally look at that, see the S, and instead of calling it the supply of loanable funds, I'll call it the saving curve. But it turns out that there's really nothing wrong with that, because the supply of loanable funds is representing the number of dollars saved by savers. So actually it's okay if you think about it that way. We're going to put these together. If we think about the supply and demand of loanable funds, the equilibrium interest rate is going to be determined by the intersection of the demand curve and the supply curve. So here's our demand for loanable funds, our supply of loanable funds. This interest rate, I'll call it R star, that's going to be the equilibrium interest rate. And of course our equilibrium quantity right here, I'll call it Q star. That's the number of dollars borrowed and the number of dollars lent in the economy. This is the amount of saving and investment that's taking place. Saving and investment. That's the number of dollars saved in the economy, the number of dollars invested in the economy. Let's think about what causes the interest rate to go to R star. So let's do something that we did previously when we were talking about demand and supply. We talked about what incentives are created that push the price to equilibrium, because remember, nobody sees the picture, right? The interest rate doesn't go to R star because everybody looks at this picture and says, oh, look, right there's what it needs to be. That doesn't happen. What happens is that there's a demand and a supply of loanable funds, and then if the interest rate is something other than R star, that creates a set of incentives that people respond to. And their behavior in response to those incentives is what pushes the interest rate to R star. It doesn't go there because anybody cares about it going there. It goes there because the beauty of a market is that the market incentives push it there. So let's talk about that for just a second. If we were to think about the demand and supply of loanable funds, let's suppose that our interest rate is something like R1. Let's call that R1. If we look at what's happening at that interest rate, what we see is right here is the supply of loanable funds. That's the number of dollars that are being saved in the economy. And if we go over to the demand curve, we can see the demand for loanable funds. That's the number of dollars that people want to borrow. So what we see is that at R1, there is a shortage of loanable funds. Now let's think about what that means. If there's a shortage of loanable funds, let's think about the incentives that are created personally for the people involved here. If you want to borrow money and there's not enough money out there for you to borrow, if you go and you ask people that are in the business of lending money and you say, hey, I want to borrow money at that interest rate, and they say, nope, I'm not going to lend it to you, there's a way that you can borrow that money. And that way that you can borrow it is to offer to pay more. That incentive is going to be felt also by the lenders. They're going to say, hey, you know what, I'm not interested in lending you money at this interest rate, but if you pay more, I'll lend to you. And so this is going to put upward pressure on the price. It's going to put upward pressure on the interest rate, and the interest rate would rise. And as it rises, the quantity supplied goes up and the quantity demanded goes down. So the shortage of loanable funds gets smaller. But until that shortage goes away, there's still going to be upward pressure on price, and that's going to push price right up to R star. At R star, there's no shortage anymore, so there's no more incentive to increase price. If we were to put our initial interest rate up there, R2, now we can do the same thing. We can see that at R2, here's the demand for loanable funds. That's the number of dollars that borrowers want to borrow at that interest rate. And right over here is the supply of loanable funds. That's how many dollars lenders want to lend. And now there's a surplus of loanable funds. So at R2, there's a surplus of loanable funds. And we know that a surplus of loanable funds puts downward pressure on the price. It's going to put downward pressure on the interest rate. If you've got dollars you want to lend and nobody wants to borrow them from you, then that's going to give you an incentive to offer to lend at a lower interest rate. So this surplus puts downward pressure. What we see is that if the interest rate is anything other than R star, there are going to be incentives created that cause people to push it to R star. So in the end, we end up right there, just like with any demand-supply model. Now let's talk about how to interpret these interest rates. We've talked a little bit about the difference between a real and a nominal interest rate. I want you to interpret these as the real interest rate. Okay. It'll be more straightforward if we do that. So now what we want to do is we want to think about using this demand and supply of loanable funds model and think about some different government policies. Okay, we want to think about some policies that might affect the savers, and we want to think about some policies that are going to affect the borrowers. And we're going to think about the impact that those policies have on the interest rate and on the number of dollars that are saved and invested in the economy. So let's start by thinking about saving incentives. So one of the things that we see about the U.S. is that households in the U.S. tend to save a smaller proportion of their income than households in other countries. And there are lots of people that have their own pet explanations for why that is. And one of the most common that I've heard is that people will say things like, well, the American consumers, American households are just more materialistic and they don't care as much about the future. And as an economist, I would say, you know what, that's a shortcut to thinking. If you want to think that's fine. But I don't find that to be a very persuasive argument. Turns out that we need to look at some of the policies that the government has put into place that affect the amount of saving and investment that's done in the economy. So let's start by thinking about what happens if the government discourages saving by taking a bigger chunk of the interest income that you earn as a saver. So we could think about, let's suppose that the government increases the capital gains tax. So an increase in capital gains tax. So the capital gains tax, capital gains is what we call the dollars that you earn when you are earning money off of a stock or a bond or something like that. Let's think in this case about dollars that are lent. So the government's going to treat that interest income as taxable income. And let's suppose that they increase the capital gains tax. So they take a bigger chunk of the interest income that you earn. Now clearly that's going to decrease the incentive to save. So if we have an increase in the capital gains tax, then that decreases the reward to saving. Decreases reward to saving. So let's think about now what's going to happen in this model as a result of an increase in the capital gains tax. So let's start with a picture of this demand and supply of loanable funds. So we've got our interest rate up here, we've got the quantity of loanable funds down here. I'm going to remember this is the number of dollars down there. We're used to having dollars up here in the form of a price. Now this is an interest rate. Still just a basic demand-supply model. We've got our demand of loanable funds, and we've got the supply of loanable funds. I'm going to call that S1 because this change in the capital gains tax is going to affect the supply of loanable funds. So let's start here at point A. Let's identify our initial interest rate, we'll call it R1, and our initial quantity of loanable funds, Q1. Now this is the amount of saving and investment that's taking place in the economy. right? That Q is the number of dollars that are saved, the number of dollars that are invested. So if we have an increase in the capital gains tax, then that decreases the reward to saving, all other things equal, and it's going to reduce. Let me put a little box around this. Let me put my story right down here. I'm going to start at A. Increase in capital gains tax. That reduces my supply of loanable funds, S1 to S2. Okay? So our supply of loanable funds shifts to the left. We get a new equilibrium at point B. New equilibrium at B. And now the coordinates of that point B are going to tell us what happens to the equilibrium interest rate and what happens to the amount of saving and investment that happens in the economy. What we see is that the equilibrium interest rate goes up, the amount of saving and investment that happens in the economy goes down. So an increase in the capital gains tax, in this simple model that we've got right here, one financial asset, increase in the capital gains tax is going to drive that interest rate up. It's going to reduce the amount of saving and investment that takes place in the economy. So all other things equal, if you have a government that has a high capital gains tax relative to other countries, we would tend to see a smaller amount of saving and investment done in that particular economy. And you might ask, well, so why does that matter? Why do we really care about the amount of saving and investment that takes place in the economy? Well, the amount of saving and investment that takes place is going to be related to future growth in that economy. All other things equal, we would expect that the higher the amount of saving and investment in the economy, the higher the future rate of growth is going to be in that economy. So we want to think carefully about any policy that decreases the amount of saving and investment that happens because of the impact that that could have on future growth. Let's take a look now at what happens if we have an incentive that affects the demand curve, so a borrowing incentive or disincentive. So I'll clear this off and then we'll take a look at that. If we think about investment incentives, then now we're going to be thinking about an incentive that affects the demand curve. The one that we're going to think about would be an investment tax credit. Investment tax credit. So an investment tax credit is going to be a good thing for a business, or if this was a household engaging in investment by taking out a mortgage, then this would be a type of policy where you might be able to deduct the interest payments that you have to make from your taxes. So an investment tax credit is a good thing. It encourages investment by reducing the cost of borrowing the money. So it gives a tax advantage to a firm if that firm's going to, say, build a factory or buy equipment, things like that. So let's do the same thing. Let's start with our demand and supply curve. Now we're going to be changing demand, so I'm going to call that D1. Our initial equilibrium is going to be right here at point A. Initial interest rate R1 and initial quantity Q1. Remember, that's the number of dollars saved and invested in the economy, the amount of saving and investment that is taking place. So now if we start there at point A, and now let's have our investment tax credit. Maybe it's a new investment tax credit, or maybe they enhance the investment tax credit that's already there. We could think about taking it away. But let's suppose that we have an increase in the investment tax credit. Well, that's going to increase the demand for loanable funds to D2. We get a new equilibrium up here at point B. That is going to end up resulting in a higher interest rate and a higher amount of saving and investment that takes place in the economy. So this is something that would increase the amount of saving and investment. So if you're looking at policies that can have a positive impact on maybe future long-term growth, the amount of saving that households do, the amount of investment that takes place in the economy, an investment tax credit would be the type of policy that you would want to look at. If we took away the investment tax credit, then that would decrease this demand curve, it would decrease the amount of saving and investment, it would decrease the interest rate. So those should give you an idea of some of the reasons that the amount of saving and investment in a particular country might be lower than other countries. You would want to look first at some of these types of policies that either encourage or discourage the amount of saving that's done. Let's talk about the impact that government budget deficits have. So let's call this government budget deficits. In my notes here, I have it written as budget government deficits and surpluses, but I think it's been long enough since we've seen a government budget surplus that I'm just going to call this government budget deficits. So let's think about the impact that a government deficit would have. So if we think about first some terminology, a deficit is going to be, we talked about just a little bit ago, that's when government spending is bigger than taxes, government tax collections. If we think about government debt, so if we were going to think about all of the accumulation of past deficits, that would accumulate into the government debt. So let's think about the impact that a deficit has, and let's do this by starting with a government that has a balanced budget. Okay, this just makes it easier to understand what's going on. We don't have to do that. We could start with a government that's running a budget deficit and then they run a bigger deficit or they continue to run a deficit. But let's start by thinking about what national saving is made up of. Remember that national saving, we saw earlier, it's equal to private saving plus public saving. And so what we're thinking about right now is this. We're thinking about public saving. Well, if government spending is bigger than taxes, then this public saving is going to be negative. So if the government starts from a balanced budget, this would be zero. And if all of a sudden they start running a deficit, this would turn negative. So the deficit would decrease national saving. The deficit decreases national saving. So now that we know that, we can think about what's going to happen in this market. So let's draw a picture. We think about starting with an equilibrium. We've got our demand for loanable funds and the supply of loanable funds. We're going to start here at point A with an initial interest rate R1, an initial amount of saving and investment that happens in the economy right there at Q1. And now all of a sudden the government starts running a budget deficit. So national saving is going to decrease. Well, this curve right there represents the supply of loanable funds. That is representing national saving. So if national saving decreases, then we go from S1 to S2. We get a new equilibrium up here at point B. We get a higher interest rate, R2, and a lower amount of saving and investment that takes place in the economy. We've got a name for what's happening right here. We say that these government deficits are crowding out private investment. It crowds out private investment because it drives up the interest rate. So this we call crowding out. And you can see that if you want to understand one of the potential implications of budget deficits, government budget deficits, is that it can have a detrimental impact on long-run growth in the future. It's going to decrease the amount of saving and investment that takes place in an economy. And all other things equal, we would expect that to have a negative impact on the amount of growth in the future. If we think about what effect a budget surplus would have, well, it would be the opposite. A budget surplus would increase national saving, drive down the interest rate, drive up the amount of saving and investment that takes place in the economy. So hopefully that gives you some idea of how this basic model of the demand and supply of loanable funds works. It gives you hopefully some idea of kind of the financial institutions in any economy, those institutions that help coordinate borrowers and savers, that bring together the amount of saving and investment that takes place in the economy. So I will see you in a future video.